1. The goal. Welcome to Be Open to Wealth, crafting a reliable monthly income stream. 2. The foundation, savings knowledge, your first steps. 3. The core engine, harnessing dividends for regular payouts. 4. Building resilience, diversification with ETFs, bonds. 5. Advanced maneuvers, boosting income with covered calls. Section 1. The goal. Crafting a reliable monthly income stream. Many people look to the stock market. They see a path to financial freedom. One clear objective is creating a steady, reliable monthly income. It's a goal that feels tangible, something you can count on. And let's be clear, it is an achievable goal, but it's not a get-rich-quick scheme. It demands a thoughtful plan. It requires discipline. It requires you to understand the landscape you are stepping into. The market can be a powerful tool for building wealth, but like any powerful tool, it must be handled with care, with respect for its potential and its dangers. This guide is designed to give you a clear, step-by-step approach. We're going to start with the basics. We'll build a foundation of knowledge and strategy. Then, we will move methodically toward more advanced concepts. This isn't about chasing fads or taking wild gambles. Section 2. The foundation. Savings, knowledge, and your first steps. The journey to market income does not begin on Wall Street. It begins at your kitchen table, with your personal budget. You need capital to invest. You need fuel for your financial engine. This fuel comes from saving. Make a conscious decision to set aside a portion of your earnings each month. It doesn't have to be huge. $50 a month can be the seed. $100 a month can be the seed. This creates a dedicated fund and makes investing systematic. Next, arm yourself with knowledge. The world of finance has its own language, and you need to become fluent in the basics. Stock Share Dividend Bond ETF Broker. A stock, or a share, represents a small piece of ownership in a public company. A dividend is a portion of that company's profits paid out to you, the shareholder. An ETF, or exchange-traded fund, is a basket of different stocks or bonds bundled into a single investment. And a broker is the platform, often an app on your phone, that you use to buy and sell these assets. Understanding these concepts is non-negotiable. Once you have some savings and a basic vocabulary, your next step is to choose where you will conduct your business. You need to select a reliable brokerage firm. It's easier than ever today. Strong reputation, low transaction fees, user-friendly platform. Read reviews from other customers, check their customer service responsiveness. Many brokers offer demo accounts, practice trading with virtual money. Familiarize yourself with the platform before risking real capital. Your initial goal: get started. The first investment is often the hardest. It feels significant. Begin small. Think of it as a pilot program. Test your process, test your broker, test your emotional response to market fluctuations. Buying a single share of a low-cost ETF is a monumental step. It turns you from a spectator into a market participant. This first move breaks inertia and sets things in motion. It's the foundation for everything else. Right, take that first step. Section 3. The core engine harnessing dividends for regular payouts. The primary engine for generating monthly income from stocks is the dividend. Many established profitable companies choose to share a portion of their earnings directly with their shareholders. These payments are dividends. When you own a share of such a company, you are entitled to receive these payments. They can be distributed monthly, but more commonly they are paid quarterly, 4 times a year. This cash flow is the lifeblood of an income-focused investment strategy. It is real money deposited directly into your brokerage account, which you can then withdraw or reinvest. This is the mechanism that turns your ownership into a source of regular cash. Your task, then, is to identify companies that are not only profitable, but also have a strong history of paying, and ideally, increasing their dividends over time. These are often large, stable businesses in sectors like consumer staples, utilities, healthcare. They are sometimes called dividend aristocrats, dividend kings, if they have track records of raising their dividends for 25 or even 50 consecutive years. This history demonstrates a company's financial stability and its commitment to returning value to its shareholders. However, it's crucial to look forward, not just backward. Let's talk directly about risk. It's a word that makes many people nervous, and for good reason. The value of stocks can, and does, go down. It's an inherent part of the system. You could lose some or all of the money you invest. That is why the first rule is simple: never invest money that you cannot afford to lose. This means you should not use funds earmarked for next month's rent, your emergency savings. The money you put into the market should be capital you can set aside for the long term, allowing it to weather the inevitable storms and grow over time. Before you make a single trade, you must define your objective. How much income do you want to generate each month? Be specific. A goal of $100 a month is very different from $1,000 a month. A smaller, more realistic target is easier to hit and helps build momentum and confidence. A larger goal will require more significant capital and a more sophisticated strategy. Knowing your destination is the first and most critical step. Without a clear target, you are simply drifting. With a clear target, every decision you make has a purpose. Picking individual stocks requires time, research, and a certain tolerance for risk. For many investors, especially those just starting, a simpler and safer path is to use exchange-traded funds, or ETFs. A dividend ETF is a single fund that holds a diversified portfolio of many different dividend-paying stocks, sometimes hundreds of them. When you buy a share of a dividend ETF, you are instantly spreading your investment across a wide range of companies. This diversification is a powerful tool for risk management. If one company in the fund cuts its dividend or performs poorly, the impact on your overall investment is muted. The beauty of an ETF lies in its simplicity and efficiency. Instead of researching and buying dozens of individual stocks to create a diversified portfolio, you can achieve a similar result with a single transaction. The fund's managers handle the work of selecting and managing the underlying stocks according to the fund's stated objective. The dividends from all the companies held within the ETF are collected by the fund and then distributed to you, the ETF shareholder, as a single payment. Many dividend ETFs are specifically designed to pay out on a monthly basis, which directly solves the challenge of creating a steady monthly income stream. To further reduce the overall volatility of your portfolio, you should consider adding another asset class: bonds. Bonds pay you scheduled interest and return your principal at the end of the term. They are generally less volatile, with more predictable payments. Once you have established a solid foundation with dividend stocks and ETFs, you may want to explore more advanced strategies to increase your monthly income. One of the most common is writing covered calls. This is an option strategy, so it requires a deeper level of understanding and carries its own specific risks. In simple terms, a covered call involves selling someone the right but not the obligation to purchase a stock that you already own. It means selling at a predetermined price, the strike price, by a certain date, the expiration date. For selling this right, or call option, you receive an immediate cash payment known as a premium. This premium is your extra income. You get to keep it no matter what happens to the stock price. If the stock price stays below the strike price by expiration, the option expires worthless. You keep your shares and the premium you collected. You can then repeat the process, selling another call option next month and collecting another premium. Building a monthly income portfolio is not a one-time event, it is an ongoing process of management and refinement. A powerful strategy for long-term growth is the ladder method, also known as dollar cost averaging. Invest a fixed amount at regular intervals, for example, every month. This removes emotion from buying and reduces the risk of investing a large sum at a market peak. It builds your position gradually and steadily over time. Watch taxes and fees closely. They reduce net income. Use tax-advantaged accounts when possible. Maintain a cash buffer for safety and opportunity. Review and rebalance once or twice a year. Sell some winners, buy laggards, keep risk in check. So, yeah, stay disciplined. Earning a consistent monthly income from the stock market is a marathon, not a sprint. It is a methodical process built on patience, discipline, and continuous learning. The key is to start small, build good habits, and let compounding work. By implementing a laddered plan, save, buy, wait, repeat, you can steadily build the cash flow you desire. A balanced mix provides a stable foundation. Explore covered calls only after gaining experience. Always protect capital with diversification and a cash buffer. Set a goal, budget and save. Open a low-fee broker. Pick a dividend ETF. Automate monthly buys. Keep a cash buffer. Track income. Rebalance. Learn before options. So, yeah, start today. Thanks for watching.